Welcome to part 2 of VCE Accounting Unit 2 Area Study 2, where we're going to be looking at Chapter 15, the twofold effect of transactions on a balance sheet. So the learning intentions are explain the twofold effect of transactions on a balance sheet and, of course, preparing a balance sheet for a trading firm. So let's go. The twofold effect is a balance sheet is prepared to report on the financial position of a business at a particular date. So every financial transaction affects at least two items on the balance sheet of a business. When GST is involved, at least three items will be affected. So with the introduction of inventory in Unit 2, new types of transactions will be introduced that impact the accounting equation. So the accounting equation is, of course, A equals L plus E, which is assets equals liabilities plus owner's equity or total equities. So we're going to be looking at some examples to help understand what the twofold effect is. So for the first example, we're going to have you are encouraged to consider a range of transactions and how they affect a balance sheet. For example, the owner contributed 50K cash to start business. So of course, we know when an owner contributes money, that's a form of capital and that's a form of, money contributed from the owner itself. So the first effect, of course, is an increase in the bank by 50K. So that's the first effect. Now the second effect is increase the owner's equity, which is capital. So of course, you know when you contribute externally to the business, you're also going to impact the bank, and you're also going to have, at the end of the day, you're going to have more money to yourself. So, no, the balance sheet must balance after every transaction. So, when we consider a balance sheet for the twofold effect, when there's one effect on the asset side, there should also be one effect on the liabilities slash owner's equity side to balance, both sides. So let's say you have, you're increasing the current asset of a bank, which is an asset, by 50K. Then you should also have a plus of 50K in the right side of your balance sheet, in your owner's equity or liability section. In this case, it's in the owner's equity section because it's a form of capital. So both sides are balanced. So let's look at the second example. The owner purchased equipment for $4,000 in cash plus GST of 400. So the first effect is increase current asset of equipment. So the left side is increased by 4,000 because we have a set of inventory slash equipment. Now the second effect is, of course, when GST comes in, we have more than two effects. So the second effect is decrease current liability. So yeah, when this is also known as a GST debt. So the third effect is a decrease in the current asset. So the bank will decrease by 4,400. So we'll have a look at the third example now. Yeah, note that the balance sheet must also balance. So when you have the first effect, which is 4,000 increase, you're also gonna, you're gonna have a decrease in the bank by 4,400. So that's gonna result in negative 400 balance on the asset section. And of course, with GST debt on the right hand side, it's also gonna be a negative 400 balance. So pretty much it balances out. So now we're buying inventory for a trading business. So two of the most common transactions for a trading business involve the buying and selling of inventory items. This may be done on credit or cash. So the buying of inventory for 500 plus GST has the following effect on the balance sheet. So think of this as another example. So when we're buying for cash, inventory increases by 500, whereas when we're buying on credit, inventory also increases by 500, right? GST debt decreases by 50 and GST debt decreases by 50. So the first two effects are the same for cash and credit, But the third effect is that for cash, the bank decreases by 550, but for credit, the accounts payable increases by 550. Because, for credit, of course, you're borrowing money to pay off something like a loan, all right? So you'll be in debt, which means you have an accounts payable of 550, which is an increase in a liability because you're owing money to someone else. You're not spending your own money. Whereas for cash, the bank decreases because you're spending your own money from your own bank, the money that you don't owe anyone. So that's the two differences between inventory for cash and credit. So when we're selling inventory on credit, to demonstrate the effect of a sale made on credit, the previous data will be used. However, it should be noted that bank is not affected by credit sale. Rather, accounts receivable is to record the credit sale. So remember, the rule is always for cash, it's the bank that's affected, but for credit, it's always accounts receivable or accounts payable. So, cost price inventory obviously is an asset, decreases by $1,000. Let's think of this like another example. So, now the cost of sales, which is an expense, decreases capital by 1,000. So that's the second effect. And the selling price, accounts receivable, which is also an asset, increases by 2,200, right? Um, GST debt, of course, when you include GST, that's an additional effect. So GST debt is a liability because like the types of GST you get, you still owe it to the ATO in a form of tax. So this increases by 200. And of course, sales, which is a revenue, increases capital by 2,000. So let's look at the note below. So four of the items are exactly the same as the previous example. Accounts receivable is used instead of bank when a credit sale is made. So yeah, like we said, for credit, it's always accounts receivable or accounts payable, but for cash, it's always bank. So in a SAC or an exam situation, you may be asked to represent transactions and their twofold effect in a range of different medium, a range of different scenarios, which may include a student making twofold effects in a table. So there's a special table known as a twofold effect table. There will be a worksheet approach. There might be an effect on the accounting equation, the A equals L plus E, my bad. Of course, being that the effect on the assets has to equal the effect on the liabilities and the owner's equity. And then finally, well, welcome back to the balance sheet. So now let's look at a twofold effect table. So this is how a twofold effect table is. Now there's a transaction column, there's a first effect column, and a second effect column. So, well, given, if there's GST, of course, there's more than two effects. But, let's look at this example. So June 1st, the owner deposited 50K. So yeah, that's a form of capital, as we talked about before. So the first effect would be, of course, since the owner deposited cash. So since he or she deposited cash of 50K, of course that's an effect for the bank, but not accounts receivable or accounts payable. So the second effect would be an increase in capital, because of course it's a form of owner's equity, by $5,000, $50,000. Now the second one is on 2nd July, it's took out an interest-only loan for 20K from Total Finance. So that's the first effect is increase cash at bank, which is an asset by $20,000. And of course, the second effect is on the right side of the balance sheet, you increase the loan, which is a liability, by 20K. So always remember the trend is the first effect would usually be an asset, right? Because it's on the left side of the balance sheet. And the second effect would usually be either um, a liability or an owner's equity, because in order to balance the accounting equation, you have to have equal effects on both sides. So on 3rd June, they bought a motorcycle for cash, $10,000 plus GST of $1,000. So of course, since it's cash, it decreases the bank, which is an asset, by $11,000, and it increases the motorcycle, which is an asset, and decreases GST debt. So now this is a worksheet approach. So what you get in an exam or a SAC is this. So you'd have a left hand side, which is the assets, and then the right hand side, which is liabilities plus owner's equity. And of course, you would have to record the effects with a negative or positive value. And of course, like you see, the 50K is positive on the left side, and then it's balancing out with the positive 50K on the right side. So like that, there's 3 examples. The examples we talked about are recorded here. So like we said, since on June 2nd they took out a loan, it affects the bank um, by 20K, and then the loan gets increased by 20K, which is the liability. So remember, for June 3rd, they bought a motorcycle for cash, which means it decreases the bank because you're using your own money. And remember, you have to add the GST as well. So when our bank goes down by 11K, our motorcycle goes up by 10K because we have the asset right now. When we buy an asset, we have the asset. So think about it like when we have a 10K motorcycle, we have 10K on our hands. So that's how you think about it. So when you add up the left hand side, you get negative $1,000. So which equals to an increase in a GST debt of $1,000, which is recorded as negative 1,000 for GST debt. So now the effect on the accounting equation is, we write down, of course, the assets, the effect on the assets, the effect on the liabilities, and the effect on the owner's equity, and that overall affects our equation and how we record it in a worksheet approach, how we saw here. So let's look at the example. For June 1st, the owner deposited 50K to a commerce business as Speed E Couriers. So if the transaction on June 1st was not recorded, what will be the effect on the accounting equation? So on the right, we can see the element. There's 3 elements: the assets, liabilities, and owner's equity. Now the effect on the assets is understated by 50K, which is the bank. Remember, the bank is a form of an asset, and right now, since this is a form of capital, it doesn't affect the liabilities because you don't pay anyone 50, you don't owe anyone 50K. In fact, it's a form of capital, so it comes under owner's equity. All right, so based on the content we have looked through, let's do a practice problem. So Jimmy Islis is the owner of South Islis Security Services. He provides you with the following list of transactions in his first week of business. All right, cool. So from July the 1st to the 7th, there's a couple of transactions. And let's look at the part of the question let's look at the instruction that the question is asking us to do. So we're supposed to prepare a worksheet to show the twofold effect of each of the following transactions. Use the following headings in your worksheet: cash at bank, office equipment, office furniture, GST liability, accounts payable, and capital. So the general trend with these headings is that they're either split up into an asset or liability, asset or an equity in this case. So let's go to our worksheet. So this is how a worksheet is laid out. There's an asset section, a liability section, and an owner's equity section. So of course, there's the different types of headings that we have. Um, when we have a bank, office equipment, and office furniture, which all come under assets. And then we have accounts payable and GST liability, which comes under liability. And we have capital, which comes under owner's equity. So to begin with, the first transaction is on July 1st. Islis invested 25K cash to commence the business. All right, so when we're looking at investing, yeah, from the owner, when the owner invests cash into a business, it's not the effect, it's not being owed to someone else, but rather it's money coming from directly from the owner, which means it's affecting the bank in a positive way. So the first transaction is an example of the bank being affected by 25,000, or you could say in this case, you could just say positive 25,000, but that simplifies on Excel to just 25,000. So now the second effect is, of course, the owner contributing money to a business is a form of capital. So it's also known as owner's equity. So we'll pop 25,000 in that. So as you can see, in the assets section, we have 25,000 for the 1st July. And of course, with the rules that we looked at in the slideshow, it has to balance out in the right hand side as well. So we have 25,000 balancing out 25,000. All right, cool. Let's go to 2nd of July. So on the 2nd, Islis purchased a computer for 2,500 cash plus GST of 250. So, okay, we have a computer being purchased from cash. So when we buy something with cash, it affects the bank as well, like the previous transaction. So we have negative 2,750. Remember, we are not only saying negative 2,500, but we're also adding on the GST. So that would total to 2,750. Now they're saying that they purchased a computer, which is a form of equipment. So essentially, the equipment will be increased by 2,500 because it's a form of a laptop, or a computer is a form of an equipment. So now on the right hand side, we have when you add, all right, let me do a quick function. So when you add these, you get negative 250. So that means the right hand side should end up in negative 250 as well. And that remaining money is in the form of GST liability. My bad. So negative 250 on the right side as well. So that's cancelled. So I've done the first two transactions. So I want you guys to, if you guys want, you can pause the video and try it out yourself. Or if you want, you can, keep watching. And yeah, so on the 3rd of July, provided security services at a nightclub and received $1,900 in cash plus 119 GST. So look at the keyword here, cash. So simply when they're saying cash, remember what they say. You plus the total that you get, you plus the amount that you get, plus the GST, which means it's 1,900 plus 190. Oh, my bad. 1,900 plus 190, and then you end up with 2,090 in the bank because it's affecting cash. So the keyword here is cash because whenever you have a cash transaction, it's impacting the bank. So our next transaction. So the assets add up to 2,090. Now the liabilities, we know with the information that we're provided with, we know that they got $190 in GST. So, well, my bad. We'll put the GST. In this case, it's just 190 because you're getting GST. You're not paying GST, but it still goes to the ATO. That's why it's a liability. So Now, in order to, complete the full equation, we must have $1,900 go somewhere. Now, that remaining, it's not a liability because you're not owing it to someone. In fact, it's the surplus that's left in your bank. So that would just go in the owner's equity as a form of capital. So now we'll go through the 4th of July. So on the 4th of July, um, purchased a laser printer on credit for 1,200, GST 120. So now it's a bit different. It's credit. So first, okay, let's do the easy part first. Okay, so it's a laser printer. So that's a form of office equipment. So, so office equipment goes up by 1,200, so plus 1,200. Now, that's the total assets. But the liabilities, however, that's what GST will be given? $120. So you put 120, negative 120 because you're paying that amount. Now, in order to fully balance out on the right side and the left side, we need to complete this equation. So remember the key word here, and as we discussed, for cash, it affects the bank, and for credit, it affects accounts payable and accounts receivable. So now we have accounts payable here. We're meant to pay that amount of money because we bought it on credit. So see, when you buy something on credit okay, let's say you want to buy a MacBook and you take a loan. Let's say you buy it on credit. You have a credit card, not a loan. You have a credit card. You pay 1,200 on a credit card. You don't owe money to that shop anymore because you pay it. You already paid the money, but you owe the credit to the credit card company. As simple as that. That's why it goes in the accounts payable. So accounts payable, in other words, increases by 1,320. So now these two are balanced. See, when you test it out, you plus it, you get 1,200 and 1,200. So let's go through last three. So for office furniture, okay, Islis contributed office furniture to the business valued at $500. He previously used the furniture at his private home, but it is no longer required. Alright, so Islis contributed office furniture. So we're given that piece of information. We have the office furniture. He donated it. Let's just say he had a piece of furniture that he donated that was worth $500 to the business. So that means it would increase the business's office furniture value by $500. So on the asset side, it's $500 plus equals, okay, plus $500. Now it has to balance out, yeah. It can't be a liability because the business is receiving something positive, so it has to be owner's equity because you have $500 more. So, all right, go to July 6th. Provided security at a high school for and received 1,200 plus 120 GST and pay. Okay, there's two parts: paid advertising and okay plus GST. Okay, so there's two parts to this question. So first, to begin with, we have 1,320. Okay, it affects the bank because they received cash. They received 1,200. So plus GST 1,320. Okay. So now what was the GST amount that they mentioned? GST amount was 120. So GST is 120 and it's, well, as you can see, it's 1,320 on the left side, which means the right side has to add up to that amount. So the remaining is 1,300, my bad, 1,200, right? Because when you add these two, you get 1,320. So let's do the last transaction. So is this withdrew $200 for personal use? So of course that is a form of owner's equity, and that's affecting the bank because you're lowering the bank by 200 of your business. So that is negative 200 on the bank. And well, you guessed it. What is it? Okay, it's negative 200 on the owner's equity or capital, because as you can see, left side is balanced and the right side is also balanced, and you're not, the business isn't losing $200 in a form of liability, like a loan, a credit, or whatever, credit transaction or GST. No, it's in this case, it's $200 is lost because the owner withdrew it, which means that they are taking the business's money to do something on their own for private use. So that's it, and I'll give you guys a quick tip for accounting on Excel. So if you want to add up all these to get the final value, all you have to do is hold this hold this top transaction and then drag down underneath until you reach the final value, and then you have your functions here. It's already set in sum. So what I'm gonna do is I'm gonna press that and it adds it up for me. So it adds the total. Now I'm gonna do that for all the columns. Um, shouldn't. Um, so yes. Quick tip here for this negative 60. It's just cancel it out. It's just 60 because it's a GST liability. Because GST anyway, you're going to be paying that money to the ATO. So there's no point saying negative or positive. It's just recorded as a normal value, a positive value, because you're paying it to the ATO anyway. So that is the worksheet analysis. So now the second part of the question is use the final results of your worksheet from part A to prepare a balance sheet as at 7 July. So now we have to convert this information into a balance sheet. So as you know, this is how a balance sheet looks like. So I'll give you a quick run through of a balance sheet. The left side, it's the same as this, where the left side as a worksheet, whereas the left side is assets, right side is the total equities. So the left side, we know it's assets, but okay, let me just put a label for reference assets, and then we'll just put a label here, equities. Okay, now the left side, as we learned in our previous area of studies, it's split up into a current asset and a non-current asset. So first we have CA. Well, I'll just write CA instead of current assets. So the first effect that we're having is our bank. Our bank is our current asset, which is being affected. So it's what's the value here? Whatever value is here. So $25,460. So that we record here, 25,460. And now our other current asset is a GST receivable, right? So GST rec, I'll just write that. And then we have $60 because it's here. So now we add up our current assets. So that's the amount, but I'll just drag it here. I'm at 2520. So Oops. So just remember, when you're always totaling up, just put it here adjacent to the last transaction. So the last record. So now let's do our non-current assets. I'm just gonna bold this. Gonna bold this text so that we can easily distinguish. Actually, I'm gonna underline it as well. So now control. Okay, so let's do our non-current assets. Draw on the line NCA. All right. So now our non-current assets. So what the business has. So this is a current asset, the bank, because the accounting period, which is 1 year or 12 months, whatever we need to use within that 12 months is a current asset, but whatever we can use, for the future after 12 months, for the future of the business, that's after 12 months, that would be considered a non-current asset. In this case, there's only two non-current assets, which is office equipment, all right, and office furniture. Actually, office equip. All right, yep, and office furniture. So when we record it, we had a total office equipment totaling to 3,700. So let's record that, $3,700, and office furniture was $500, totaling to oh, my bad, 700 and 500, totaling to 4,200. Now, in this case, what we have to do here is we have to total our assets. So we have our total assets, which we'll add these, and we get 29,720. So let's do our liabilities, which is the same. It's a bit different when you're doing owner's equity as well. So we have our current liabilities, right? Now, accounts payable, GST are the only form of liability. So in this case, accounts payable is our current liability. So we have accounts payable, accounts pay, which results to 1320, as we can see from the worksheet. And then GST liability, however, is already added in our non-current asset. It's already in our current assets, as you can see, because it's you're getting the positive amount. So we have now, since we don't have any other current liabilities, we move on to our owner's equity. In this case, OE, just say OE and underline. So our first form of owner's equity is capital, our only form actually. So capital in total, what do we have? So now this is a bit different. So for capital, let's see. So it said Islis invested $25,000 in cash to commence the business. So when you're recording capital, you don't just write down, okay, 28400 here, because that's the total here. You don't, because in your way, in those let's say in those 7 days that Islis has started his business, in the first week of his business, they didn't earn that much capital. They didn't contribute that much capital initially. They their capital increased because of transactions and contributions later on. So we'll put the initial contribution, which is 25,000. Now we know that a total of 28,400 was the owner's equity. So we have two more. Our first one, we'll start with the drawings. So when we minus drawings, my bad. So when we minus drawings, let's see in this question, Islis withdrew. Look at the 7th of July. He withdrew $200 for personal use. So that is taking away $200 from the business, and eventually he's losing 200 from capital. So that is how much he drew. So we'll put this as maybe 200. Now, when you add these up, you also have the profit, which you calculate. So let's quickly add these up. Okay. So you have that much money, but the profit is the residual that's left over for the business to either have as a a personal use, or expanding the business for the future. But yeah, that's the amount of profit that's there. So owner's equity consists of these three elements. Now, of course, we total this. We have, okay, first we total the current liabilities, and then let's total this amount. Yep. So we have to have 284. So remember, drawings in this case is a positive because you have the drawing, so it's 28,400 in total. So when you add these two up, you have yep. So our assets and liabilities are matched. So these are not called liabilities; these are called equities. So they're matched up. My bad, guys. I made a small error. So when we were recording at Capital, we knew that initially the Islis contributed 25K cash to commence the business, but later on we also knew that the office furniture was contributed at $500. So the total of the liabilities, the owner's equity that was contributed is to 25,000 plus 500, because the office furniture plus the initial amount that Islis contributed. So now it's 25,500, and the withdrawal, the drawings was a negative value because it impacted the owner's equity, or the equities, in a negative way. So then now the total should add up to 28,400, and in this case we will put this amount here, 400. So now when we have in total, we have this amount, this current liabilities plus the owner's equity, which adds up to 29,720. And as you can see, both the total assets and the total equity section match up. So that pretty much concludes this lesson. So in summary, we have completed chapter 15, which looked at twofold effects of transactions, where the accounting equation was affected in more than one way. And in summary, today we learned how to make a worksheet for uh, displaying twofold effects of transactions for both credit and cash. And we also converted this information into confined, a concise balance sheet, which consisted of the assets, the current assets and current non-current assets, and the liabilities, with the effects on capital and all the other elements. So see you guys in the next part, which is the final part, chapter 18.